Howdy, Jacob here. Today we're looking at Boston Scientific Corporation in the healthcare equipment and supplies industry. I view this as maybe a younger, more hip Medtronic. And I say young relatively. They're still incorporated in 1979, but a company that Minnesota based, had one right near my house when I was younger, founded in 1949. But 113 billion market cap, 120 billion enterprise value. They do have a little bit of net debt here. Their revenue has been fairly impressive outside of COVID. I mean, you're looking at upper single digit revenue growth year over year, so that's positive. Gross margin very consistent, hovering around the high 60s, low 70% range. That's amazing. Operating margin in the high teens, also another positive. They're not paying the dividends, so they're likely reinvesting a lot, maybe buying back a lot of shares. Return on invested capital historically is very low, though, so that's kind of surprising to me. Their income statement, let's look at R&D. Okay, so pretty solid increase in R&D, not quite double, and the revenue is pretty much double. So they haven't increased R&D as much as revenue, but I mean, you're still looking at a $1.4 billion used for likely future growth, or not likely, but the possibility of future growth and future earnings and bottom line impacts there. So that's a positive. Balance sheet has 865 million cash on hand, 531 short-term debt, 8.6 billion long-term debt. That's a lot of debt here, okay? So net about 8 billion. Let's see what that is in relation to cash flow. So free cash flow is in the mid between 1 and 1.5 billion. I mean, 8 billion is a lot compared to that. You're looking at maybe 6 years of their free cash flow there, 7 years of their free cash flow. That's a good amount. That's a lot of debt. Okay. So the company will have to focus a bit of their debt on debt reduction, because even if their debt is growing as much as or their free cash flow is growing as much as it has, and it is almost double what it was 10 years ago. So again, the ratio of free cash flow to debt, if that numerator goes up because your free cash flow goes up, that's going to make their ratio a little bit less. But even still, the company is really just paying a lot for acquisitions, which is increasing their growth, but they're also going into debt to fund a lot of that. And we want them to use their available free cash flow to fund those projects. I mean, it's not bad to go into debt sometimes, but to have a 6, 7 times your free cash flow is a lot. And so their use of cash is really just acquisitions here. They're just buying a lot of companies to fund their growth. And that's not the most advantageous way I would suggest growing, but they seem to be doing an all right job at it because their operating margins are increasing. Gross margins are pretty consistent. So it's hitting the bottom and top line relatively the same. Revenue, if we're starting to make some assumptions here on the revenue growth side, I think that a 7% a year seems pretty reasonable for margins. Let's do maybe 11 and 12. Share change, stock-based compensation is 241 million. I mean, that's not a lot of their market cap. So maybe let's just do 0.5% there. From stock-based compensation, P, price to free cash flow. I mean, not the best return on invested capital, but they are growing pretty heavily, but it is through acquisitions, not necessarily organic. Can they keep it going in the future? Let's just go essentially market average and then a 15% return. Okay. This is not fantastic. So this is saying that the company's stock price needs to fall 86% to get to the return I'm looking for here. Maybe I'm missing something, but to me, it is a great company. It's a very solid company. But the return on invested capital being as poor as it is and them being as aged as they are, I don't really like. They're just growing through acquisitions for the most part. I don't really like that. 64 current PE with essentially the highest margins they've ever had. I definitely don't like that. So this might be a company that I just never own. There's a possibility of it, but not. I don't have to own every fantastic company. But then again, I think all companies will very likely get to a point that some population isn't going to want it, which will depreciate the price enough to where me as a value investor will think it's an attractive price. But for me right now, that's a no. I'm Boston Scientific. Hopefully you enjoy the video and have a great day. Thank you.